Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Baig, Chief Economist, welcoming you to our 121st episode. We are recording this episode from PwC's Washington, D.C. office. Today's guest and I are both here for the spring meetings of the IMF and the World Bank. She is, in fact, a return guest. Dr. Alexis Crowe is partner at PwC, where she leads the global geopolitical investing practice, which kind of tells you what we're going to discuss today, our takeaways from the IMF meetings, and what it means for the global economy going forward. Alexis Crowe, welcome to Kopi Time.
Thanks so much for having me back, Taimur.
Great to have you back. Lots going on. Let's talk about the 3 or 4 key takeaways that you have from the meeting so far.
Sure. Well, I think firstly, just starting on growth, the IMF World Economic Outlook has quite a rosy and robust outlook for global growth going forward. This is predicated upon the assumption that we continue in this jobs-rich recovery, where we've had tight labor markets across the globe. Although worrisomely, part of that is supported by a perhaps overly sanguine view on immigration, supporting some of these job numbers. Also, perhaps an overly sanguine view on headline inflation, especially amidst the current crisis unfolding across the Middle East, the prolonged conflict between Russia and Ukraine, and this rewriting of global energy maps, just watching the way that headline passes through into core inflation. The second key takeaway I would say is in the Global Financial Stability Report, there is actually a refreshing coverage of private credit risks and how this can generate financial vulnerabilities within markets. And so I think that's important because some regulators are really underplaying this and perhaps underestimating the extent to which some kind of private credit event could really upend this economic recovery that we've been experiencing. The third one that I would call out would be the green silence. We actually had one central banker comment the extent to which it's perhaps unfashionable to discuss climate change today, which really, if we think about our experience in these meetings over the years, like that's unheard of. These meetings have always been the incredible garnering point for talking about sustainable finance. And so that's really a market departure.
It's interesting, Alexis, on that last point. I had the privilege of talking to the team that does the climate finance-related modeling at the IMF. And, there's some discussion about whether the IMF should be leading this work or the World Bank should be. But it turns out that there is a critical mass, at least at the staff level. What we hear in these annual meetings and spring meetings a lot of time is what the officials are dictating the theme. I'm sort of heartened to see, at least at the staff level, there's still good work going on.
And it's so interesting because I think in terms of age group, what historically even the World Economic Forum's Global Risk Report shows that for ages 18 to 24, sea level rise, anything associated with climate change is number one risk. But for perhaps executives with more experience, it doesn't necessarily always rank top.
Right. For us, sitting in Singapore and then coming all the way to Washington and not hear a lot of urgency is a bit jarring, especially since despite all the China-US friction, the amount of money that is being spent by the Chinese on green transition is truly transformational. And it's definitely having a halo effect on the region. And so when you come all the way here, you'd think that between the Europeans and the Americans and the Chinese, there'll be a lot of noise being made. But I, like you, felt that it was a bit underwhelming.
Perhaps, Taimur, this also indicates the extent to which there's a very strong European focus in these meetings. Because I actually heard the head of the sustainability of one of the European banks state when justifying a potential financing of hydrocarbons or hydrocarbon-associated investments, said, we can't look at the world as if it's 2021 anymore, i.e. because of the urgency that was dictated by Russia's invasion of Ukraine and the sustained energy price shocks in Europe. Therefore, banks and asset managers and institutional investors are saying we need to look at carbon a different way than we were perhaps doing in 2020.
Lots of different ways of looking at it these days, Alexis. Even the whole China-US issue is now getting enwrapped into the climate change issue. In my view, if the Chinese are subsidizing green transition in their own economy and creating excess capacity, it's great for the world. We can all buy Chinese subsidized solar cells and hasten our move toward green transition. That is not the message that is coming across. So both from the American and the European perspective, the cost of green transition has to be combined with the cost of resiliency and national security.
Sure.
And therefore, they probably would not want to have the Chinese supply all the equipment and machinery for green transition.
So, said in another way, climate change is becoming this matter of national security for some countries. And I think it's interesting the way in which Europe has really awakened to the influx of BEVs, as this is like where you start to see the green protectionism really emerging. But I mean, calling out the cost piece is very important, because the second US slaps solar, tariffs on solar panels from China, prices of solar production go up and skyrocket in the United States. So it is important, especially when we're trying to combat inflation.
Absolutely, absolutely. So I'll share with you my 3 takeaways. Actually, some of them are kind of similar to yours. So one is, of course, the surprising growth resilience in recent years notwithstanding, we should remember that the pandemic did leave substantial scars in the global economy. And I think the IMF's current estimate is it'll be 2027, 2028 before trend growth is sort of making up for the loss of output. And then the damage inflicted by both the pandemic and the ongoing sort of geoeconomic fragmentation is manifesting in lower TFP. I think that was an important lesson, that sometimes we think about geopolitical tension in isolation of the economic narrative, but they're actually intertwined. My second one was the term overcapacity. It wasn't around when you and I last met in the IMF annual meetings in Marrakesh, but now it's all the rage. Being pushed by the US Treasury, it seems like, and did take on added urgency during Secretary Yellen's visit to China. And the other issue that I saw probably didn't get as much attention, but I think it has shelf life going forward beyond overcapacity, is this trilateral dialogue between the Americans and the Japanese and the Koreans, where they talked about exchange rate misalignment. And this is an interesting one, because unlike, say, 5-6 years ago, when RMB's undervaluation was considered a major source of global misalignment, I haven't really heard anybody talk about that a lot. But the fact that the yen has depreciated a lot, the won has depreciated a lot, I think makes the...
Despite recent moves by the BOJ. I mean, nothing true about this.
And I think it is being seen as a misalignment argument, which I think some people in Washington, D.C. don't quite agree with. And on that is my third takeaway, is that there were certain aspects of what the U.S. agenda for the spring meetings are, which are not aligned with maybe what the IMF's staff level agenda happens to be. So one would be, of course, the whole issue of the dollar related to the misalignment, that the Americans seem to think that, the dollar probably needs to adjust, and vis-a-vis, therefore, yen and won and other currencies need to appreciate. Whereas I think when I see what the U.S. team for the IMF is talking about, is that it's not really about currency misalignment. Externally, whether one looks at U.S. external account balances or the dollar, they don't seem to reflect anything anomalous. The real anomaly in the room is the U.S. fiscal policy.
Yes,
there is,
stoking demand,
exactly.
Therefore, pushing out the timeline for rate cuts, which would, of course, then cool the dollar.
Right. So what's your sense of inflation and rates?
Well, I just want to come back to some of the key takeaways. So firstly, on the scarring piece, what's interesting is I think the WEO this April was actually a little bit more sanguine on the scarring piece from the pandemic. But we also have to ask, when we look at the downside, what's also the upside? And what's interesting to note is, in thinking about improvements to productivity, and particularly in advanced economies, where, like, if you look at work by Robert Gordon, right, we've just been on this downward trajectory. What was in, with the exception of the kind of 9 exceptional years of the early days of the ICT revolution. What's interesting to note is that data from the US and other advanced economies, including Italy, the UK, France, Canada, show that white-collar services activity that was relegated to home in the early days of the pandemic, actually the productivity gains in that sector actually stemmed the plunge in GDP drop. So during the pandemic. So said another way, when we were all locked at home, we were actually much more efficient.
I could still record podcasts.
You could, and we did one together.
Yes, indeed, yes.
But as evidence from the Virginia Fed shows, like, these productivity gains wane over time. In part because it's not necessarily so productive to be in your pajamas and not be convening with others and learning from this, particularly for the younger generation. So that's interesting to note, and that's something that Austin Goolsbee and others at the US Fed have picked up, which is that we have noticed some of these improvements in productivity. So that's in one way positive, that it offsets some of the other scarring. I think where what we've heard throughout the meetings is that it's the lower income countries where the scarring has been most deeply felt, right? So particularly looking to the bottom of the income stack. Also, you mentioned this trilateral meeting on currency. One interesting thing that I've been picking up is another trilateral dialogue, very important, that happened here in Washington just before the spring meetings between the Philippines, Marcos from the Philippines, and Kishida-san from Japan, and Biden. And that's crucial because if you look at the changing winds of geoeconomic fragmentation, the relationship of US and China, their alignment within the Asia-Pacific region, what's interesting to note, I mean, there's been a serious, I would say, stiffening of the Philippines' position, right? And so it's also interesting if you track Chinese outbound investment into Asia-Pacific last year, guess how much was spent in Philippines?
Not much.
Zero, right? So that's, I think, another interesting theme to pick up, is that, you know, Asia is a diverse region, and we are seeing, I think, different shifting alignments coming here. On currency, inflation, fiscal side of things, I think it's fascinating. I mean, I think one key dominant theme of the meetings and in the weeks that have preceded the meetings has been, I call this the pundits' referendum on fiscal. Said another way, even though the Republicans and Democrats seem to be completely aligned on one thing, which is ignoring the deficit, that has not escaped the eyes of all of us gathered here. And the U.S. has been called out front and center. Now, Olivier Blanchard used to call this out too, and unfortunately the U.S. didn't really ever do anything about it. But now you've heard very strong cries from former Treasury secretaries here in the U.S. that it's a key risk in the dashboard of the global economy. And of course, we're hearing calls from the Europeans, like, tamper down the fiscal because you're continuing to stoke demand and it's making our work harder.
Right. It seems to me that the argument coming from the staff level at the Treasury and elsewhere is that, of course, we need to consolidate fiscally, but we do have the exorbitant privilege of printing our deficit in US dollars, and where else are you going to spend your investment dollars in other than buying AAA-rated US Treasuries? I think that you can probably take that complacency a bit too far. And we have seen in the past, when we do see, particularly in the long duration asset side, sometimes there could be very few bids, and that could create anomalies and distortions in the market. And that is not just a problem for the US, it can create financial stability issues all over the world. So yeah, one would hope that there's a little more seriousness about this thing. But seriously, I mean, I don't see, and I'm sure you'll agree with me, in the House or the Senate, any urgency toward correcting the fiscal path.
No, this is one thing on which Democrats, I would say it's ignoring the fiscal deficit and China bashing are the two things that are uniting Republicans and Dems.
Yeah, absolutely. And on the inflation side, one hears that some of the stuff that has spooked the market in the last 3 months are transitory, that whether it is auto insurance rate or home rentals, they will be coming down later in the year, and therefore the Fed might still have a decent window to cut rates. What's your take?
Look, I mean, the fact that shelter costs represent over 1/3 of CPI, which is the Fed's preferred measure, I think is very concerning. And that's something that we keep bringing into these discussions because a lot of high-flying bankers, with all due respect, don't always see the plight of what is at the heart of the cost of living crisis, not just energy costs, it's shelter costs. And we have a chronic shortage of supply in affordable housing here in the United States. Latest data shows that over 50% of renters in the United States face unaffordability, which is extraordinary. And again, you have to think about it. It's not housing for the homeless or low income. It's also middle income. Guess what? COVID didn't kill the city. And so we have record rents in the United States, in New York right now. So I think that's important. I do think that many are complacent about it. And when I quiz central bankers about it, sometimes they say, well, we shouldn't be looking at house prices. Well, of course, you can see the extent to which governments have called, for example, like the Reserve Bank of New Zealand, to task for how did your monetary policy since the GFC contribute to just stoking prices. So I think that's concerning. And my forecast is, I think the number of factors that have contributed to this crisis of affordability are not going to go away anytime soon.
That's right. So I did see some analytical work being done about global housing inflation, because although it's become a big issue in the US, but it exists in a bunch of other jurisdictions as well. So I think some of the work that I saw done by the IMF, they picked up 4 or 5 risk factors that, household leverage, exposure to only short duration borrowing as opposed to long duration borrowing, so the rates do get adjusted upward and creates even more pressure, and then banking systems overexposure to the housing market and so on. I think there are many developed markets where many of these factors are flashing red lights.
Yes.
In the US, I guess one saving grace is that thanks to the extremely low interest rates in 2020 and 2021,
fixed year,
a lot of people went for the fixed rates, and therefore the pain that is right now on the borrower side could have been much worse.
Yes. Which calls out another important point that was an interesting piece in the WIA was that household servicing of debt in the United States remain relatively modest by historical standards. So everybody's talking about, record tightening, but actually, if you look at it, it's about 9.8% of disposable income, which is not what it was decades ago. So that's, I think, and that's another reason why demand has been more immune to the rate hiking cycle, because consumers just have more leverage at their capacity.
Correct. So there's a whole level versus difference issue, right? That rate of inflation may have come down. It's no longer 8-9%, but people do recoil when they do grocery shopping and see their grocery bills being 30%, 40% higher than it was 4 years ago.
Which is leading to an unanchoring of inflation expectations.
Correct. Yeah. And on the issue of prices beyond housing, I think on energy prices, although $3 gallon gas captures headlines, the fact of the matter is in real terms, energy prices are lower than they were in the peak of 2008 or earlier. So the affordability is actually substantially more.
Sure. And I think Europe, that's where you see a country like Germany being at the heart of the crisis, right? Which, comparatively speaking, the U.S. has just had such limited exposure to the crisis and conflict in Russia.
Correct. Now, switch from there to something that might seem unrelated to the discussion we've had on macro so far, but I think there is some macro relevance there: artificial intelligence, because 2023 was a year of AI, with NVIDIA hitting record after record and billions of dollars of investments going into this area. We are now in the middle of 2024, so we've had a year and a half since ChatGPT came into everybody's consciousness. So what's your sense about its world-changing potential?
Well, first of all, I would say I think there's a huge over-reliance on AI to be this panacea for improving total factor productivity. And that's a true theme coming out of these meetings. And it's so funny because going back to the recovery packages that were announced cascading across the globe from COVID, everything was green and digital. Right? Everything was green. And everyone promised all these, halcyon worldviews about green and digital. And I mean, it's in every single government document. With the exception of, I would say, South Korea, which was kind of much more meaningful on the Green New Deal. But on the digital front, everyone is focused on Gen AI, either the dark side of what happens if robots take over our lives, and so the dark side of the labor market, that all of a sudden we're not going to have any, there won't be jobs for our children, etc. As well as the dark side in terms of governance, what happens if AI becomes too dangerous. But again, on the hopeful side, I think there's just far too much invested in the power for Gen AI to unlock productivity. Now, I give an example of the ways in which you can have productivity gains from technology, of the very clear inefficiency of taking research and gathering research when I was an undergrad. So I won't name the university because I don't want to name names, but you would go to the stacks in the library, and you would go and you would take the journals and you would photocopy them. You would put coins, maybe a card, maybe a plastic card, into the photocopy machine. And then maybe the journals weren't there on the shelves. Somebody else, there was like one notorious guy who would hoard the journals because he didn't want anybody else to get the research. And you would photocopy these, and then you'd take your photocopies and you'd sit at your desk. Now, when I was doing a piece on the future of work, I was sitting in Toronto hotel room, and unfortunately, I'm not so green, I like having paper. And I needed about 10 journal articles for this piece before taking a flight. So I just sent all of the attachments to the front desk. They printed them for me. So what used to take probably 2 days took less than 1 hour. And so that's what I talk about. Those are the kind of efficiency gains that have happened. But a robot an AI didn't write my piece for me. And so I think that's where people are sort of stumbling. And we had a fantastic panel yesterday on AI in the global economy. And I think it's very clear that other researchers are perhaps more balanced in what kinds of productivity gains we can actually have.
So that balance, I think, is not reflected in Wall Street, where anything with the .ai is getting,
or Silicon Valley,
or Silicon Valley for that matter, right? So it remains to be seen how disruptive the Gen AI large language model wave is. I mean, you do see certain reports arguing that in certain aspects of the service sector, there can be substantial productivity enhancement, but not across the board yet.
And what I see in my cursory research, and again, I promised I'm going to do a piece on this in the summer, so we'll get to talk about it. But in my cursory research, what I see is that the efficiency gains are happening for the least skilled people. So said another way, like a clerical desk job, a passive investor, like those are the types of things that, are likely to be disintermediated more.
But what worries me is that if I can do very good research and not need research assistants, what would happen to the future of research assistants? How would they ever learn? Because as an RA, you learn through osmosis, you work with a senior researcher and you pick up stuff. But during that time, you do a lot of grunt work. If all the grunt work will be done by the Gen AI, how will you ever grow or how will you ever get the exposure?
Yeah, no, I still think it's probably going to be a foundation for judgment and analytical capabilities that you can't replace.
Right. Summer interns, don't lose hope. I want to talk a little bit about this whole higher for longer narrative, whether we are right in our concern for inflation going forward or not. The fact of the matter is, we've had now nearly 2 years of fairly high nominal and real interest rates, and it looks like it's not coming down anytime soon. Now, I don't worry too much about it in the context of the U.S. The country has done well in the last few years. There's been a lot of gains on the portfolio side. So perhaps, there is substantial absorptive capacity with respect to higher interest rates if it were to get, stuck in the horizon for another 6, 12 months. But what about the rest of the world?
Right.
Where do we see risks manifesting if rates do remain high for the foreseeable future?
Well, it's so interesting, actually. Research from the BIS shows that the tightening that we experienced from exiting from the pandemic through to 2022 was unprecedented. 95% of central banks tightened around the world. So we've never even seen that in the energy price. So I would say one good thing about it is that it was actually distinctly well correlated with a lot of the EMDE central bankers having front-loaded those rate hikes, which was, I think, pacifying when we think about the near history of the taper tantrum, right? So I think that has been a positive dynamic. So when we look particularly even to Latin American central banks, additionally thinking about financial stability in the wake of this unprecedented tightening, you saw a lot of Asian central banks pioneering some techniques that were used by advanced economies in the wake of the GFC and pioneered those to instill greater fiscal buffers to ensure price stability going forward. So I think all of those have been positive dynamics that have led to a less fragile outlook. Right. But of course, now, as we say, there's clear castigation of the U.S. You need to cool this down so that you can actually enter into some kind of cut territory.
Correct. And I think, although we haven't talked a lot about the risk coming from a strong dollar in the last couple of years, I have a feeling 2024 will be the year when, if the dollar strength sustains, it's going to become a big issue. The kind of depreciation pressure we've seen already in Korea and Japan, exactly.
Yeah. I was actually just looking at a chart of DXY this morning, and we have not seen, so hovering around 104, we've not seen these numbers since 2002. Right. That's striking. I mean, you look at a chart, that is absolutely striking. And again, coming back to the BOJ, the much-awaited, long-awaited exit from NERP, ZERP, maybe.
And didn't amount to much.
Nothing, yeah.
So I think this makes, again, the BOJ quite nervous. So I think before attempting to get into the normalization mode, they were worried that it might lead to an overshoot of the exchange rate on the appreciation side. Nothing whatsoever has happened, which hopefully gives them a little more confidence that they can continue with normalization in the second half of 2024. But at the same time, if that normalization leads to additional stresses in the economy, because it is the largest indebted economy in the world, they do have risk on the interest rate side.
Yeah.
So
but
you have to weigh.
On the upside, to come back to that, like we talk about scarring, but where's the upside? On the upside, look at the performance of Topix companies.
Yeah.
Right?
Yeah.
And certain automotive manufacturers, it's been an extraordinary boon,
Right.
even looking to demand in China and the US.
Right. But Alexis, for me, Japan is somewhat of a revelation that we have talked about Japan in the context of lost decades and the futility of negative interest rate policy. But through it all, Japan's sort of investment in R&D, search for excellence in frontier technology has continued unabated. And the Japanese companies are reaping the rewards for that.
Particularly those outbound ink, right?
Right.
And the trading houses. But what's another thing that's tied to this, and something that we've also focused on throughout the meetings this week, is the exemplary role of Japan as an infrastructure investor in this world. So in an age of decoupling of certain elements of the commercial relationship between the US and China, so many people are focused on this Beijing and Washington. Very few are focused on the third nations, and Japan is a standout example here.
I fully agree. We don't think of Japan as a deliverer of public goods in the world, but especially when you come to DC and when you realize that the technical assistance that many countries around the world get, a large part of this underwritten by Japanese development authorities,
Yep.
you come to appreciate Japan's role in this multilateral setting as well.
Yes, absolutely. One of the top shareholders in the ADB, and actually recently launched a new fund, LEAP2, to be able to invest in pockets of Asia Pacific and looking to improve growth outlooks, support the energy transition. So I think it's fantastic.
Yeah. Europeans are not particularly vocal in these meetings, it seems like, but did you pick up anything interesting from the Europeans, ECB or EU or individual governments?
There's a little bit of shaming on the U.S. on the deficit, right? So, a lot of people have called out the extent to which, across the Eurozone, you're looking at a median deficit that's much more restrained comparatively to the U.S.
Right.
So there's some shaming there. I've also seen quite a lot of talk about just the extent to which the U.S. economy is that much larger than Europe. And so then there's this trading back and forth. Is that off the back of, an ever-expanding fiscal deficit? One interesting point that was brought up by President Lagarde is how Europe, structural reforms, and how Europe needs to support innovation. And she made the astute observation very clearly that you have a brain drain within Europe. She said, we innovate, but then the innovators go elsewhere. So I would have asked a follow-up question is, okay, so what needs to be in place? Do you need to have strong venture capital funding? If you look at an economy like Canada, where you have Kitchener-Waterloo, extraordinary innovation being driven there, has historically been a dearth of venture capital. So you see actually people in Seattle just poaching talent from neighboring Vancouver. So you've also seen a brain drain of some of that rich talent in France going straight to Quebec. And so how Europe adjusts to this is one question. And others have also rightly observed that Europe can generally be better at regulating tech versus growing tech.
Oh, they're being pretty strident in that, aren't they? Now, look, the IMF World Bank meetings are largely about economics and finance, but defense-related spending, the imperative for that, I think for Europe has never been bigger. So when we think about drivers of growth for the rest of the decade, we like to think...
Or supporting higher R-star.
Correct, yeah. That we like to think that, growth could be driven by spending on climate change, on technology, innovation, but it seems like a big chunk of growth for Europe will come from defense-related spending.
Timur, I have to ask, I wonder how sticky this is going to be. We were looking at charts of defense spending as a percentage of GDP across the globe recently and thinking about concerning levels of debt. And I was just looking at historical charts for certain countries, and even countries where you've seen a larger percentage, that's not always been so sticky. Greece would be a great example here. And so I question the extent to how sticky that's going to be. Maybe a lot will ride on who comes into the White House.
I was about to go right there. Yes, exactly. I think that, but I suppose the experience of the war in Ukraine for Europe has been a chastening one.
Yeah.
And the imperative to sort of have homegrown technologies and capabilities and even more arms and ammo and soldiers, I think has gone up, in my view, somewhat structurally higher. I mean, you can be uncharitable and say that that is because of the previous administration sort of harassment of European governments, but you could also say that even without that, the act of Russia's invasion of Ukraine alone, even if the Democrats were in power at that time, or the previous 4 years, would have probably led Europe to sort of look inward a little more. You earlier mentioned a little bit about Europe sort of waking up to the Chinese overcapacity on the EV side. We're hearing rumblings that there might be, unilateral tariffs levied on Chinese exports. What's your sense? Do you think they'll pull this through?
From Europe?
Yeah.
Yeah. I mean, what's interesting to know is if you look at the summit last October, there was a lot of chatter within the EU that, okay, we've just hit a run-up in the trade deficit with China. But part of the reason for that is that Europe has sustained this severe energy price shock.
Yeah.
So if you think about it, like that's more of a weakening and an etiolation of Eurozone export capacity. Right? It's not China stopped buying.
Correct.
So it's interesting. I think there needs to be a little bit of a reality check there. I would say that the extent to which Europe will be protectionist on China against the energy transition, I think is probably, I think that's a reality that doesn't seem to be reversed anytime soon.
So would you argue then that Europe and China have a deeper symbiosis than US and China?
Historically, that's been the case. Mm-hmm. But I'm seeing the winds shift here a bit.
Right.
Now, that is temporarily, I think, related to the energy transition and minerals and materials to support the energy transition. I don't see that seeping over into finance or asset management yet.
Right.
In the way that we have witnessed that seeping over in the US.
Right. You mentioning the word finance and asset management gives me the best segue imaginable. Going back to our key takeaways from the meetings and concerns about the global economic landscape going forward, one area where we just don't have very good visibility is the private side of the market, private debt, private equity. And I think it's a normal sense, or normally it's okay to sort of worry that if we don't have a lot of data in that area's vulnerability, fragility may be underestimated. So are you seeing work being done to get a sense of that risk?
It's interesting. The FSB, the Bank of England, the ECB are really the front runners here. And BIS has obviously historically called this out since, really strong coverage since 2017. I have not seen the Fed really be as concerned. And as we were just sharing in the green room before, I do think that it takes a private credit or a credit event to usher in regulation. How and why did this emerge? I would say that financial risk, and I'm going to take a little bit of a Keynesian approach here. I would say financial, or Minsky's adaptation of Keynes. Financial risk moves like liquid mercury. It doesn't ever evaporate. It just moves from one place to another. So we regulated all of that risky lending out of the globally systemic important banks in the wake of the crisis.
Right.
And it went somewhere. And where did it go? Well, you look at assets under management on a global scale, and those under the non-bank financial intermediaries has absolutely eclipsed that of the traditional banks. And so within that subset is this private credit market. And I would say there is zero visibility or transparency into the balance sheets of some of these entities, into the potential for liquidity mismatches, but the yields are fantastic. Yeah. And so pension funds, very worrisomely, have been crowding into this asset class in their fiduciary duty, perhaps not even thinking about the longer-term systemic risks of what happens if you have some kind of a tumble. Now, regulators call out, the IMF and others have called out that the gilts crisis in the UK would be a great example of that, where you could have significant liquidity mismatches. You even saw that in the wake of Brexit, with some asset managers needing to impose gating mechanisms, right? Because to fund redemptions and mass redemptions. And we saw with the banking wobbles last March in the United States just how quickly you can have a run on the bank scenario and some kind of a contagion, which was contained very well, I would say, by the regulators. So in private credit, you've seen pension funds channeling $100 billion into the space. Now, again, my forecast is that you see some kind of an event shaking out at 2025. We've seen a modest engagement on capital markets by a lot of the U.S. issuers because you saw debt issuance actually down. So I think if you go back out to capital markets with higher rates, there's a concern. Also, there's a potential contagion and correlation between private credit supporting some wobbly parts of the real estate sector. So looking specifically to office.
Right. Look, I'm happy that our forecasts were too cautious, and I'm happy that we got it wrong on the positive side. So growth has turned out to be more resilient. Great. I'm happy to be wrong in that direction. But I do worry that upward surprise that the U.S. growth turned out to be much stronger and EM did not fall into an abyss because of high interest rates has led to very stretched valuations. So whether we look at the PE of the equity market or we look at the spreads of public and private debt, it's all priced for perfection.
Yeah.
And given the headlines these days, we're not living in a perfect world by any stretch of imagination.
Sure.
So how it all pans out in the next 12 months makes me worry. It's a bit like, the cover of The Economist. It's always a lagging indicator of what's not going to work going forward. So I sort of wonder that this sort of feel-good sentiment that you and I have picked out in these meetings, that, world markets turn out to be okay, maybe like the last of the good stuff.
No, super lofty valuations, and one of those that we've seen that there's zero room for price discovery between buyers and sellers on office real estate in the U.S. specifically. You've seen some people take mark-to-market losses in the European market. Commercial real estate, as overall, was the most distressed sector in Europe in 2023, but we've not seen that shake out in the U.S. yet.
Right. And even you and I are sitting in Washington, D.C., but any large city in the U.S., you go to New York, Washington, L.A., everywhere we see the CRE space under a lot of stress.
Yes. I mean, it's interesting. I mean, there's been this whole rich debate on bringing federal workers back into the office. You're seeing that happen in states and cities, and a state like California. And that's also connected to this issue of public safety, which is one acutely felt in the U.S.
Right. And again, nothing happens in isolation. The work from home certainly had an impact on both residential and commercial real estate spaces. But the cost of living crisis, that how much more expensive it is to rent or live in a city from services to rental, that also combines to add to the stress on this asset class.
Yeah, it's interesting. And the Fed has called out this, I think the verdict is still out as to how sticky the fleeing to the suburbs is. So the Fed refers to this as the donut effect, where the outside of the urban center has become ever more core.
Yeah.
We've been tracking patent creation and small business growth in some of these Sunbelt states. So you've actually seen new business filings in the Sunbelt states completely skyrocket.
Right.
Because if you didn't need to be tied to your desk in New York, and I say that as a New Yorker, if you didn't need to be tied to your desk in New York, you could flee to Arizona or you could flee to Florida. And you could also start your own side business. Again, I would say that not as a PwC person,
right.
And so we've seen that happen, and that's showing up in the data. I don't think, I'm going to side with Glazer on this one, I don't think that means the death of the gateway city. I think with immigration numbers and et cetera, you will see new entrants into the labor market coming into these cities, again, contributing to the crisis of affordability.
Right. So finally, Alexis, we haven't really talked a lot about U.S.-China friction. We've sort of tangentially touched on that, but maybe we end on that one. What's your sense? I mean, going into the election in November, is there incentive to diffuse the tension, or is there incentive to actually exacerbate?
Yeah, I'm seeing stoking. Going back to Bismarck, if you think about the ability to look to an external enemy to garner a political base is so Germany wasn't unified, and von Bismarck used the Franco-Prussian War as a way of unifying this. And so I'm seeing, our forecast was that when Biden would come in, you would see a change in tone with regard to Beijing, but not a change in stance. And we continue to witness that. And you hear some other allied partners say, well, hey, this administration has actually been quite protectionist toward us as well.
Yeah.
A lot of concern around the IRA and national champions and supporting things through subsidies. So on US-China, what I think is important to point out is, and Secretary Yellen's continued dialogue with counterparts in Beijing is evidence of this. There are elements of the commercial relationship between the US and China which seem to be still relegated in a valueless sphere, i.e. our import of furniture, light electronics, textiles, plastics, medical equipment, baby chairs, etc. These seem to be still kosher.
Right.
Now, I am not sure in a change in administration how that would play out.
Yeah. No, it's a slippery slope because I think it all began with national security direct. Then it's like national security tangential and peripheral, and now we can probably even end up getting into the furniture side. Let's hope not, because I think that there are certain things as you go up the income ladder, it just makes no sense to produce, and you want somebody else to produce it. Just like we're seeing Chinese capital move out of China to produce some things that is not cost effective to produce in China anymore.
Well, and it's interesting. I mean, I would also just call out, again, with this hyper-focus on US-China, there are winners of geoeconomic fragmentation, right? Vietnam being one of those, India being another one, Bangladesh, I mean, obviously, as you know.
Yeah, and if you look in North America, both Mexico and Canada, huge inflow of investment and jobs and production, 1,100 Chinese companies working out of Mexico.
Fascinating.
Yes, indeed. Alexis, this was a great tour de force. Thank you so much for your time and insights.
Thank you for having me.
Thanks to our listeners too. Copy Time was produced by Ken Delbridge. Violet Lee and Daisy Sharma provided additional assistance. It is for information only and does not offer any trade recommendations. All 121 episodes of the podcast are available on Apple, Google, and Spotify, and on all other major platforms, including YouTube. For our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.